Welcome everyone to today's asset protection webinar. As most of you know, this is a long-running series. We've been going for over 10 years now, and I'll show you some. We've had some great webinars this year. What an amazing lineup of people we've had! But this is kind of the last webinar that we'll do this year, and what a tremendous topic of year-end tax strategy planning, minimizing our taxes, maximizing our deductions, and we are very pleased to have Scott Estill, former senior trial attorney from the IRS, tax attorney with us. Scott has been a friend of Protect Wealth Academy for 20 years now, and we've absolutely enjoyed our friendship. We love his knowledge of the tax code and just kind of his easygoing love for teaching. And so we're excited to have you on, Scott. Thank you for being here. And then just a couple little housekeeping items. We'll turn the time over to Scott. The format is I'm going to do a quick introduction, and Scott's going to teach. If you have questions, hold those till the end, and then we'll leave at least a half an hour or so to answer questions. But chances are I've gone through his presentation. I pretty much done it. It looks like he's laid it out very, very sequentially so that it's designed to answer most of the questions before you even ask them. So hold your questions if you can until the end, and then we'll bat the questions back and forth as long as we're able to do that tonight. So okay. Again, amazing webinars we've had over this last year. Advanced tax strategy, planning with statutory trusts. Clint taught that. We've had Jill and Roberta Hootie on talking about retirement planning. Jill is the president of a really fine custodial IRA group. We've talked about grants and loans and scholarships and legal structures, how to create patents and copyrights. We've talked about how to avoid lawsuits with dispute resolutions with a really good friend of ours, attorney Steve Sumption. We've talked about estate planning. We had Kwame Granderson, a brilliant attorney who's raised over $1 billion in venture capital, talk about where he sees the real estate market going, cost segregation. This is just a few of the webinars. We normally will do 2 or 3 webinars a month. And so if you're new to us, all of these webinars are recorded on our YouTube channel. If you're not familiar with that, what you would do is go to YouTube. Everybody knows that. Type in Protect Wealth Academy and hit subscribe. And when you do that, then you'll have access to all of those recordings that we've done. We generally keep those recordings up and available for about 30 to 60 days, and then we kind of rotate them in the channel. And so not everything that we've ever done is on our YouTube channel, but we rotate them and try to keep things a little bit fresh for you. The 3-day summits that we've got coming out, this is where we're bringing some of the best speakers, attorneys in the nation. Dr. William Danko has been coming for the last few summits. It's been such a delight to have him. He's, as most of you know, he's the co-author of The Millionaire Next Door and Richer Than a Millionaire. Jill Banner has been with us often. Clint Coons is always there. Mike and Stacy, some of the best stock market investors anywhere in the nation. We really do bring some of the best that we know on stock market, on real estate, but especially asset protection and tax. So if you haven't joined us in the past, we invite you to do that. The upcoming webinar or the summits that we have, January 24th through 26th. This is a Monday, Tuesday, Wednesday class. The next one is March 7th through 9th. That is also a Monday, Tuesday, Wednesday class. The whole theme of the class is a lifetime to accumulate, 3 days to protect. If you're going to kind of be in and out, during the 3 days, we would rather you book a future one. Our reason for that is students that come in and hear half of a tax strategy or half of a legal strategy and don't hear to the end. They walk away being a little bit more dangerous maybe than they should be. Give us 3 days and we can get you to a whole new realm of understanding on the tax and legal side. And we're delighted to do that, but you kind of have to focus. Give us your focus for 3 days and we can get you where we need you to go. If you're interested in looking at the agenda, we've got a sample agenda. The agendas will change up until, usually the day or before as schedules for our speakers change, but a good overview of what it is we teach is always available on our website. And then before we talk any tax and legal strategies, we're going to throw out a lot of ideas tonight, but not every idea that we're going to teach applies to you. And so always, whenever we're talking tax and legal, run these ideas past a professional, whether it's in our group or otherwise. Take a look. Scott will be very, very accurate in what we teach, but the application might vary depending on you and your tax situation. So be careful of that. We'll be true and honest, but it's not always applicable and relevant to you. So with that, so delighted to have Scott on, and I'm delighted to have Scott, obviously, but also this great topic. And we've got a lot of people on tonight. So Scott, they didn't come to hear me, they came to hear you. Scott, we're going to turn the screen over to you and let's take it away.
All right, Don. See if I made the technology work here.
Okay.
Are we good?
I think I'm still on my screen.
That's good, Scott. I can see you on this end.
Okay.
Yep.
There we go.
There we go. All right. Very well. Thank you. Thank you, Don. Thank you, Kendall, for getting everything set up here and get us ready to get going. Sorry, I'm looking at my screen here, and I guess I've got kind of a yellow sort of a complexion here, but that's the best I can do with the lighting. So yellow or not, we're going forward with our 2021 year-end tax planning. And as I was talking to Don before tonight, it's amazing. There's only a couple weeks left in the year here. And, it seems like with Hanukkah just passed, Christmas coming up, whatever you may be celebrating towards the end of the year. What we don't know, though, is what are the tax laws? And so that's what I'm going to talk about tonight is what do we do with this year-end tax planning, this, uncertainty that we have so that, we don't end up with this little meme that I want to start off tonight with. And that is, hey, let's not give all of our money to the IRS, right? Let's figure out a way to have a tax plan. Certainly not only for just like the next couple weeks here of 2021, but also what are you going to be doing for January of 22 and beyond? Have you even considered from your investment standpoint or your business standpoint, maybe for your real estate rental properties or whatever, just what is the plan? Because again, you can overpay your taxes every year, and the IRS will have no trouble cashing your check every single year. But, if you want the strategies and you want to know what the options are, you've got to take the next step forward, right? You've got to start figuring some of this stuff out. So what are some of the things that we're going to be looking at here? And, I think the biggest problem that we have right now is that we don't know what the law is going to be next year. So the 2021 law is set and the 2022 law is set, assuming that it doesn't get changed. And the assuming it doesn't get changed part is the real wild card here. Because if we go back 4 years to where the Republicans were under the Trump tax cuts, those got passed and signed into law between Christmas and New Year's. So the very last week of the year. And we could see that again this year. And if that happens, whatever those changes may be, whether they're in our favor. In other words, they somehow reduce our taxes, or they're against us by increasing our taxes, denying expenses or reducing deductions or credits or what have you. All of this is still up in the air right now. So you've got to look at a couple different things. I think one is, let's assume that the tax brackets and rates and nothing changes between 21 and 22. What is going to change in your particular situation? Do you think your income in 21 is going to be considerably lower or higher than 22? For instance, maybe I'm going to make $50,000 in 21, but I'm going to make $500,000 next year because I'm, selling some stuff, or 21 was a down year, 22 isn't. And so if that's the situation, then where I know I'm going to make more money next year, then my expenses that I have that I get to deduct are going to be worth more next year as well, because my tax bracket is going to be higher. Obviously, if the tax laws change, and I'll talk about that in a few minutes here, then, well, all bets are off, right? Then we got to figure out, well, what are these changes, and is there anything we can do? Look at also capital gains and dividends on our investments. Certainly want to be looking at that along with how that's going to be calculated and at what rate. And I'll talk about that, as well as how we're going to look at maybe the income distributions from a flow-through entity. So these distributions, what I'm talking about here, typically through an S corporation. So some of the distributions, some of the money, I guess, let me back up, eliminate that distribution word there and say some of the money that I receive, let's say from an S corp, is going to be in the form of wages, but some of it can come via distributions as well. And there's different tax ramifications for that. Mainly, there's no employment taxes on the distributions that we would have with the wages and bonuses. So how we take this money, what format, from which entity, what type of entity, I guess is a better way to put it, all of this comes into play as far as income timing and expense timing, so that we can get the most bang for our buck. The other way that I want to look at the timing issues, as far as the income and expense issues with timing, I want to look at the expense timing, not only from a business standpoint. When should I buy that computer? Should I buy it in the next couple of weeks, or should I defer it out till 2022, or does it matter? But I also want to look at the standard deduction versus itemized deductions. And this is something that you can play out between the two different tax years. And here's kind of what I'm talking about with this bunching deductions. And I have a couple of things down here that specifically work really well with the bunching deductions. So if we look at in 2021, and let's say that I'm married and I file a joint return, my standard deduction is going to be $25,100. And if we look at the caps here, like we have this cap on taxes, the SALT is state and local taxes of $10,000. And let's say that we didn't rent, or we rented a place for the year, and so we didn't have any mortgage interest, and we don't have enough charity or whatever. We're going to be looking at taking the standard deduction. And so in that case, and let's say then in 2022, or maybe let's say this month in 2021, we buy a house. So we know then in 2022 that we're going to be paying a lot of mortgage interest. And when you put that with our state and local taxes, you put it with our medical expenses, perhaps, and our charity, we're going to be way over this $25,900. So what we can do from a tax perspective then is we can bunch our deductions. Maybe you don't make any more charitable contributions for the rest of this year, and you make them all on January 2nd. And that way you can still get the standard deduction for this year, while also then getting the full amount of the itemized deductions next year. And, and I think that's like a really, really big component of this. And again, I'm not saying, well, just avoid charity this year. I'm looking at it from, if you can get a deduction for it one year and not the other, then let's bunch those charitable deductions in that year, especially at this point, right? Where you can make a charitable donation on December 30th or January 2nd. And, realistically, it won't matter to the charity, right? I mean, either way, they're going to get the money within a few days. But if you can get a tax benefit out of doing it one way or the other, then that may incentivize you to make the donation at a certain time, and also maybe to give more money, knowing you'll get a tax deduction. So again, lots of thoughts come into the different ways that we can go over with the bunching of the expenses. And, medical expenses, I mentioned, where you may have a situation where end of the year, if you're going to be itemizing deductions this year, maybe you go and you buy eyeglasses, or you have dental exams or something where it's not a necessary medical expense, but it's something you do on a preventative, sort of a proactive annual basis. And that's why I have the flex accounts up here as well, because a lot of times we do see these use it or lose it type of situations where you've got this money in a flex account, and maybe your account doesn't allow it to be rolled over. And so if you're in a situation to use it or lose it, then let's go out and let's get the over-the-counter expenses, or eyeglasses, or dental, or, like I said, anything where you can spend the money rather than losing it. And of course, if you can roll the money over, then that's fine. And the same thing with this as far as the Schedule A deductions, where if you have a lot of medical expenses this year, you might want to incur some more to get the most amount for the deduction. So again, this is all varied depending on who you are, depending on what your tax situation is. And like Don mentioned at the beginning, these may be good ideas, but they're not right for everybody. And let's just keep all that in mind. Capital gains and losses this year. This is something that a lot of financial planners, for which I'm not, but a lot of financial planners recommend taking a look at your basis and your losses. So you can harvest losses. And what that means is that if you go through and let's say that you maybe have $30,000 of stock market gains this year, you could have losses of $30,000 to zero out that gain, plus another $3,000 of losses to deduct against other income. Now, maybe you want to do that, but maybe you don't. And the reason I would say maybe you don't is that, is there going to be a lower tax rate for you or for people in general this year than next? And what I'm talking about here is not necessarily the income tax rate, although obviously that's a concern, but I'm talking about the capital gains tax rate. And what are we going to do there as far as the capital gains rate goes? And I'll show you what I mean in a minute here. But understand that we may want to incur capital gains this year and rebuy the stock. So if I buy Microsoft at $100 and I sell it at $120, and now I have a $20,000, whatever happens to be gain, I may want to book that gain this year at, let's say, a 15% rate, reset my basis. And then if the capital gains rate goes up next year or the following year, then I've got a higher basis to be taxed at the higher rate. Be aware that if you have a loss and you want to deduct that loss, you have to wait at least 31 days before you buy it back. Okay. And so if you have a $5,000 loss on a certain security today, you have to wait 31 days. Usually I say 30 days, and on the 31st day, go ahead and buy it back. And if you want to do that, then you get to keep the loss. Otherwise, you have what's called a wash sale. This does not apply, though, to cryptos. And so this is something that you may want to take a look at. Let's say that you bought $100,000 worth of Bitcoin and it's worth $80,000. You could sell that now, book the loss of $20,000, and immediately turn around and buy it back for $80,000. And that $20,000 loss is tax deductible against any capital gains. So this is the one exception. I would expect this exception to the rule to be changed next year if it's not changed in, an end of the year tax package. So it is a really nice loophole for not only cryptos, but any type of currency traders, because they're not considered to be securities. So only that applies only to the currency type trades. Here's what I was talking about, though, on the capital gains, and that is that we have different capital gains rates depending on who you are. And this 0% tax rate is not a misprint. And so what this means is that if you're a single individual, and this is taxable income, so after my itemized deductions or my standard deduction, if I make less than $40,400 a year, okay, and we can double that if we have a married couple, so we go up to this $80,800. If my taxable income is less than that, my capital gains tax rate is 0. So what you should be thinking here is, what if I have a single individual? Let's say I have my daughter who is making a W-2 of, let's say $50,000 after deductions and everything. She's under this 40,000. Any stock that she would be selling could be potentially taxed at 0%, or at least some of it at 0%. And so this is where gifting comes in. And so I'll be talking about some of the gifting issues in a few minutes, but it's something I want you to consider, because the gifting comes into play real nice as far as some of the current tax plans. All right, here's the first example. And that is, we have Homer top income tax bracket, whatever that may be. So this year we're at 37% because we're in 2021. He's got XYZ, he's going to sell it, and he's got this $50,000 capital gain. Homer sells it this year. He pays the highest tax rate, 20%. This ACA surtax is the Affordable Care Act. So this is Obamacare. So this capital gains rate is at 23.8% at the federal level. I've thrown in a 5% arbitrary state tax. Obviously, you could be in Nevada where there is no tax, or you could be in California where it could be a 13% tax. But just for this hypothetical here, Homer's paying a blended 28.8% rate, state and federal, what have you. So $14,400 goes to the IRS, rest goes to Homer. Homer doesn't like that. So he holds on to the stock and sells it next year. Now, here's our problem. We don't know what the tax rates are going to be next year. Maybe they're the same as example 1, where you sell it next year, it's the same as this year. But there's talk of floating a higher capital gains tax. There's also talk of floating this rich surtax. Now, I don't know what rich means, and maybe you're rich, maybe you're not. The Affordable Care Act, state tax still stay the same. But in this case, Homer delaying the sale until, let's say, January of 22 is going to cost him $4,000 of extra tax if the taxes go up. And again, I don't know if that's going to happen or not. But if they do, that's something that we need to be aware of. Homer doesn't like that. And so he says, all right, I'm going to take this $50,000 and I'm going to gift it to my daughter. Can I do that? Yes. Is there tax due? No, there isn't. But there is a gift tax return that Homer has to file. And so Homer, in this case, would file a gift tax return, take out his $15,000 annual exemption, and he would have a $35,000 amount to report on the gift tax that would go against his annual lifetime exclusion. And so as long as he hasn't used that up in the past, and I'll show you what that is in a few slides, he's good to go. So even though there's a gift tax return due, most likely 99% of the time, no taxes are owed. But by doing that and having his adult daughter who's in the lowest bracket sell it, now she doesn't have to pay capital gains, and we don't have this Obamacare tax. And so all we have is the state income tax, and there the family is saving almost 16 grand. So that's something that I want you to think about when you're looking at the gifting. All right, consideration numero cinco, retirement planning. And this is one that so many businesses, they just don't get. This is like free money at times, where you're getting an opportunity depending on the type of plan. Maybe it's a set plan or a 401k. And it can be a traditional 401 or a Roth 401. But if you start looking at this $58,000 that can be put in under these SEP plans or 401ks and potentially get a tax deduction, as long as we're not dealing with this Roth guy right here, we can get a tax deduction for the amount of the contribution. And you can vary it every year. So this isn't something that you have to do the same amount every single year. And there's even a real nice provision here if you're over age 50 anytime this year, is that you can add in these extra amounts in addition to what I had up on the last slide. And so you can kick in another grand to the $6,000 you could put into your IRA. So you could put a $7,000 amount in. And this plays out, I think really well. Take a look at this, example 4 here with Anna. 40-year-old, $100,000 salary. Here's what she can do in 2021. She can kick in a quarter of her salary. She can have, with a solo 401k with the match, this match meaning a corporate match here, $58,000 can go in. She could also put into a simple. Once she picks out one of these 3, then she can also contribute the $6,000. So in theory, she could contribute $58,000 of the 401k and $6,000 here. So another $6,000 to $64,000 then. And as this example shows, we just bump up her age by 15 years, and now she's 55. So all we've done here is now make her eligible for the not only the matches, but the catch-up provisions. And this is something that a lot of business owners don't understand, and they don't realize, is that they don't play the game and maximize the amount, not only that you can contribute to get the upfront tax deduction, but the amount that you can make tax deferred income all along, right? And so if I'm 40 years old, or let's say I'm Anna here, I'm 55 years old here, and I'm not going to pull this money out for 15 years, and I put $7,000 into an IRA, that $7,000 grows to whatever. Those earnings have never been taxed. Of course, they're going to be taxed when you pull it out. But anyways, that's what we can do with the catch-up provisions. And just to show you just a real basic example here of no contribution at all, $100,000 profit. I'm throwing this person into a hypothetical 24% bracket, also a little state tax there. So this person pays $29,000 in tax. What if they want to pay less tax? They can still be in this tax bracket of 29%, but if they make one $25,000 contribution to a 401k, they're getting a 29% return on their investment in the first year with the tax savings at this bracket. And I think that's the really big thing that a lot of people don't realize, that you put this into a money market account, you're $25,000 and you still have $25,000 after 12 months, right? Because you have gotten virtually, pennies in interest. You've still gotten a 29% return in the sense of you've, gotten the tax relief. In this case, to $7,200. Now, obviously, if you can get a nice return on that investment, then that makes this all the better. And let's look at, one of these examples of, how would I look at this from a really long-term effect? So here we have 2 kids, 15 and 17, both of them working for their business, okay, for some business. So let's say it's my business here. I pay my kids each $8,000. Let's say that's a fair and reasonable salary. They really worked for it. They each make a $6,000 contribution to their IRA. And over the next 50 years, 48 years, whatever it is, to these guys get to retirement age, they get the S&P 500 average annual return. So I looked it up, and that's what the 7.96% is. When these guys hit age 65, look at the account values. Now, obviously, the second one here is going to have 2 years less of compounding. So that's why his is, about 30K less. But we've taken one contribution of 6,000, and if we just match the S&P 500, we're going to turn that into somewhere around $250,000 on one contribution. Now, what if they put that same $6,000 into a taxable account and then had income taxes pulled out of that every year at their 28% bracket? Now, obviously, your bracket could be higher, lower, or whatever. But now, just by having the taxes pulled out, here's what these guys, they went from about $250,000 to a little less than 100,000. And that's what taxes have eaten up over the years on one $6,000 investment. And so this is huge. When you look at tax savings in the retirement account, again, we're at 150 to 175,000 or so, depending on the ages here, just matching what the S&P 500 has done historically. Now, maybe you self-direct that and you can double this. I don't know. I don't know what you can do as far as what investments you're looking to do. But this is on, again, one $6,000 contribution or a deposit to an account. Huge tax savings. And now imagine if we take that amount, that same amount, and now we take some of the wages that we paid them, and they each get to make a little bit higher contribution, right? Because now not only can they do the IRA, but they can do the SEP as well. And so again, on a very, very small amount of money, we can get to over $300,000. And here, our second guy gets a little bit better off. They're both right around 350, simply because he could put in a little more upfront if the salary was a little higher for the older kid. But you get the picture here, right? You get the picture that, we're talking about, again, massive tax savings, because this is the amount that they'd have if they invested it in a taxable account. So simply by tax deferring these accounts, we're getting tax savings here of a couple $100,000, and this is real money, right? I mean, we're talking about $225,000 of actual tax savings. So again, if you're not looking at this, you're really, really missing the big picture, I think, because there's so many different advantages, I guess, to those that are in business, right? We can all contribute to an IRA if we have wages, if we have some sort of earned income, but we have our own business, and now we can really, really supercharge it with contributing to a SEP or solo 401ks, Roth or otherwise. So look at the retirement plans. Don't just dismiss them. All right. As far as the choice of business entity, and just so you know, I am going to take any questions at the end here. So I have seen some of the questions popping up or raising hands or whatever. This is being recorded, yes. So there was a question on that, but I will get to the questions at the very end. So anyways, choice of business entity, real important from a tax perspective. What's the difference between these two? Well, absolutely nothing. A C and an S corp are identical, except for the way they're taxed. Are we going to tax this at the shareholder level, or are we going to tax it at the corporate level? And that can make a real big difference depending on who the shareholders are. Be aware, though, that a lot of times I'll see small business owners, they'll just automatically set up a single member LLC, which means that they file as a disregarded entity, a Schedule C, no tax planning, and there will be this 15.3% self-employment tax on the net profits. So you still need, even if you set up an LLC, you still want to look at, do I want this tax as a disregarded entity, which certainly you may, or do I want to elect to have it taxed as an S or a C corp? which you can with an LLC. And I know Don has several different webinars available through YouTube or through Protect Wealth on choice of entity. And I'm not going to go into that, but be aware from a tax perspective, forget asset protection, forget estate planning, but just from a tax perspective, how you decide to run your business can have major, major ramifications to how much taxes that business ultimately pays. Depreciation as well. Section 179 and bonus depreciation. I have not seen anything that is going to change these for next year. Doesn't mean that they won't, but Section 179 is going to go up, I think, to $1,080,000. The heavy vehicle rule I just saw today is going to go up to 27,000. So that was at 25,000, then it went up to around 26. Now it's going to go up to 27,000. A couple points I want to make about depreciation, right? Not a terribly exciting topic here, but one thing is that you are permitted to opt out of bonus depreciation. And this is one of the strategies that I discuss at the 3-day Protect Wealth events, in that when you claim bonus depreciation or depreciation in general, or Section 179, all of this is all interrelated to who you are. So I could talk to 10 different ones, let's say 10 of you that are on this presentation this evening, and we could come up with 10 different strategies, even though each of you, let's say, bought a $20,000 piece of equipment for your warehouse or a factory or whatever. And so how we use Section 179, whether we use it in 21, whether we use it in 2022, whether we use it in a combination of both of those years, whether we use it in 21, 22, 23, and out into further years, all of this, we can decide what is going to be best for us and how can we get the most bang for our buck. Now, the final bullet point here is a big one. You have to put the asset into service this year to claim a deduction this year. So if you go out and you buy a computer on December 31st and it gets delivered on January 10th, you do not get to deduct it this year. You have to deduct it next year when you put it into service. Now, if you go out on December 31st, buy the computer, bring it back to your office and set it up and put it into service, then you're good to go. But remember, you have to take delivery of the asset that you're depreciating and put it into service sometime in 2021. But a lot of choices, and a lot of people, business owners especially, don't realize you've got a whole lot of potential choices here, not only with depreciation, but a lot of other things. All right. I want you to consider also, as we look at the last, 20 some days, 20 days of the year, whatever we've got, along with the next 12 months with potential tax changes. And that's going to apply for all of us as individuals, but it's also going to apply for all of us as business owners, whether we own a business as a C Corp or whether we own a business as anything else, and we're dealing with this QBI stuff. Again, I've done webinars on this. I talk about the qualified business income quite a bit at the 3-day events. Just be aware that the QBI is a potential 20% tax deduction for any business entity, any business at all that's not a C Corp. Okay. And then the other thing is capital gains, that we could be seeing big changes on capital gains, potentially for real estate investors, and then also for anybody that trades stocks or bonds or mutual funds or whatever. So what am I looking at here for potential changes? And notice, and I'm going to circle this one a few times here, the potential word. I have no clue what's going to happen in the next couple of weeks, let alone the next 12 months. But these are the things that I'm looking at for myself and my businesses and what have you as to what is likely to happen. If there are tax increases next year, I would expect the top income tax bracket to go up from 37 back to where it was in 2017, okay, before the Trump tax cuts. Top tax rate is going to hit single and individual earners at a much lower rate. When Biden talked about the income taxes would not be going up for those who make less than 400K or 450 for the married folks, he was correct. They're not. But the top tax bracket is going to hit at a much lower amount. And so you're going to see income tax rates go up for those who make over these amounts. You may see itemized deductions capped if you earn more than this 400,000. This one, I think, is not as likely to pass as both of these two are. But again, these are potential. Same thing with this rich person surtax that I had on that one example back there with the stock sale. They're looking at 3%, 5%, bunch of different amounts for those whose adjusted gross income. So this is not taxable income. This is your before any deductions or whatever, is more than 2.5 or 5 million. I think this has a reasonable chance to pass. Taxing long-term capital gains at a higher rate, maybe pass, maybe not. Reducing this qualified small business stock. This is something that I don't think will happen, but it's been proposed. And what somebody was telling me when I was on a webinar a couple of weeks ago, it was actually in the UK, but this gentleman was talking about the fact that anytime you see something proposed in US tax laws, doesn't it seem like even if that gets defeated, that it comes back at some point in the future? And, and I thought it was a really astute comment, because I think that's true, that we may not see a long-term capital gains tax rate here hike. So it may not go from 20% to 25%. But the fact that this is being floated right now means that we could very well see this in the future, if not this year, maybe next year. All right. Other potential issues here, and I want to talk about gifting, decreasing the estate tax exclusion to 5 million. I don't know if this is going to happen or not, but it's something that I want to talk about on the gifting slide. Tax benefits on like-kind exchanges. This is for real estate investors who do the 1031 exchanges. This one I don't think is going to go through. And likewise, I don't think that employment taxes, this is Social Security and FICA, are going to get increased as well. But notice throughout, we keep seeing 400,000, 400,000. This seems to be the sweet spot, that if your income is less than this, you probably aren't going to get hit with these higher taxes. But if your income is higher than that, then I think you need to look at the plans. And certainly, do you want to bump up income into 2021 in case some of these potential changes actually come into play? All right. Charitable donations in 2021. The general rule here is that you take your adjusted gross income, and whatever that number is, 60% of that amount is the maximum that you can claim as a charitable deduction. So if I have $100,000 of income and I donate $100,000, in most years, my deduction would be capped at 60%. That's 60,000, and the other 40,000 then would get kicked into the next year. This year, that rule is eliminated. And so you can, notice I say you can, you don't have to, you can deduct all 100% of that. Now, this is for a public charity. This is not a private foundation where the 30% rule still applies. So if it had a 60% limitation in the past, for 2021, that amount has been replaced with 100. So what does that mean? Well, at this example here, I have an adjusted gross income of a couple $100,000. I have some mortgage interest and some taxes of 25,000. I could then donate 175,000 to, let's say, a church or a temple or whatever, and I could end up paying nothing in tax. And saving, in this case, almost $7,900 in tax and wiping out all of my income. That is one thing that I can do. I can also decide that I don't want to do that. And I elect, notice I can do this, elect to use the 60% limitation. Why would I do that? Well, the reason I would do that is because I am going to pay this amount of tax this year at a 14% income tax rate. And if I'm in a higher tax bracket, I can take that 55K that I couldn't deduct, right here, that I'm deducting here, not the whole 175,000, but I couldn't deduct this amount, this 55,000. So that goes to next year, where presumably I'm going to be in a higher bracket, okay, or the tax laws are going to be higher. So again, it's my choice as to which way I want to go on that. All right, moving on here from this cool cartoon, gifting strategies. I mentioned that I'm going to take a look at these. This is an income shifting opportunity. So you can gift appreciated assets like stocks or bonds or whatever. And without filing a gift tax return, you can do this $15,000 gift per person per year. And that number goes up to 16 next year. So in theory, you could give $31,000 to a person over 2 days, right? You could give $15,000 on December 31st and $16,000 on January 1st. And you can do that to anybody that you want. Okay, so it does not have to be a relative or whatever. And if you're married, this $31,000, you could in effect double that to $62,000. And each spouse does 15, and then each spouse does 16 for 21 and 22. Mentioned the estate tax exclusion. And so the example I gave before, where there was a gift of a stock and assuming that the gift did not go over this lifetime amount, it's 11.7 million, we're good to go. There's no gift tax. This amount, I think, is around 11.9 million next year, but there has been talk of dropping that down to 5 million. Whether that happens or not, I have no clue. But I do like the gifting strategy, certainly for this year, if you're in that position. Several reasons, actually. Just be aware, though, before you make the gift, that any of the gifts that you make that generate income, once the investment income for your kids goes over this $2,200, you will have to pay tax at your rate. So it's not a way that you can gift away millions of dollars of dividend income. But what I've seen a lot of investment advisors advise their clients is, what if you gifted over stock that was not paying dividends, or paying a very small dividend? In other words, it's incurring capital gains. Therefore, at some point then, when the capital gains are incurred, then they're going to be taxed at a much lower rate. So be aware, though, that we have to watch the amount of investment income that minor children earn in order to play this rule off and maximize the tax benefits. But some of the reasons I like the gifting, obviously, we can get the asset out of our estate now. So if you gift $15,000 in 2021, obviously that is getting rid of that $15,000 from your estate, but also, and this is the big one, the appreciation on that asset from the estate as well. So you can do the gifts for 2021 now, 2022, beginning January 1. There's no limit for qualified tuition or medical expenses. And this is another really, really nice provision. So that $15,000 limit doesn't apply. Gift of appreciated securities, have the child sell the securities and then avoid or reduce the capital gains. Like this intra-family planning. So many of the times it's set up a C Corp, set up an S Corp, and we'll do this and that, and this will do this with this business and whatever. And yeah, you may be able to do some of that. But the reality is here is intra-family planning can be really, really favorable, a way to get the family's tax rates down to the lowest possible way. And then again, if there is a reduction down the road in the estate tax exclusion, we've now taken a proactive approach by getting rid of some of these assets. And so what if Congress now says that 11.8 million is now 3.5 million or 5 million? And again, those are numbers that have been floated around. Well, 3.5 million now impacts a lot more people than 11.8 million. And if we can get rid of some of these assets from somebody who has, let's say, an estate that's worth $5 million, now we can do it while the law is favorable, while we don't even, we're not close to the 11.8 million, but looking basically towards the future of what happens when this changes. Notice I said when and not if. I'm expecting a change. I just don't know when it's going to be. All right, Roth conversions. We've just got a couple more here, and then I certainly get to your questions. I'm trying to be cognizant and ending this by 7:30, my time on my share of the presentation here. But on the Roth conversions, question I get asked all the time, and I got hit with this one in Las Vegas too, is should I convert to a Roth? I was like, well, how do I know, right? I don't know who you are. I don't know what your situation is, but understand that when you do a Roth conversion, and if you do it this year, it is going to have a tax implication this year. So when you take money from a traditional IRA and you convert it to a Roth, you will pay taxes on that this year. Why would you do that? Well, obviously, you want to get to a Roth IRA. And the difference is that a Roth IRA never pays taxes on the distributions. Okay. I mean, there's limited exceptions to that, like everything else. Got to have it in 5 years. There's whatever. But if you're taking the money out during retirement out of your traditional IRA, it's going to be taxed. You take it out of the Roth, it's not. The other big thing is that there are these RMDs, required minimum distributions, that come from a traditional IRA. So once you reach age 72 this year, you have to take money out of your IRA, whereas with a Roth, you do not. So you can allow that to keep growing tax-free. And potential tax changes in the future. And I think this is the big one. There's all kinds of talk about limiting people with a certain amount of income, who knows what that is, from having the ability to be able to convert from a traditional to a Roth. And so if you want to do this and you're a higher income person, whatever that may mean, you may want to look at making this conversion today. Do it in 21, pay the taxes now, because this fourth bullet point here, this guy down here, this could be a big one. This slide here shows just kind of what we can be looking at, and right down the middle here is sort of our sweet spot where there's really no big difference. The blue is going to be our Roth advantage, and our brownish color is going to be a traditional advantage. And what we're looking at here is, what is our tax rate today, and what is our tax rate expected to be during retirement? Now, this is really difficult for people that are close to retirement, right? Because we don't know what the tax rate's going to be in 2 years, 5 years, 10 years. How difficult do you think it's going to be for somebody who's 25 and now has to say, well, what's my tax rate going to be in 40 years? Who knows, right? But we have to take some guesses here. And so if we look at today and we say, well, I'm in the 35% bracket today. Well, I'd have to look at my taxes in the future, and it would really have to get up to 40% where it would be beneficial for me to do the conversion, because I'm in a high bracket today. But what if I was in this bracket, where 25% or a 15% bracket? There, it's going to be a much easier approach, right? Much, much more likely that the Roth conversion is going to be beneficial. And typically, the more money that you have to work with and the longer your time frame, the more benefit there is to converting to a Roth. But this is a financial planning decision. What I want you to be aware of is that you need to run the numbers and figure out, is it a good deal or not? But you will have tax consequences if you convert from a traditional to a Roth. So keep that in mind. You will be paying taxes this year. Let's look at Steph here. And we have a 35-year-old, has 50K in her traditional IRA. She comes to a financial planner, and the financial planner says, well, you can just leave it all there and we'll just keep investing in the traditional IRA, right? That's option number one. Option number two is, well, you can convert some of this or all of it to a Roth. And they run some numbers, and I'm right back to using this really beautiful 7.96 number here. And so in this 30 years of compounding in this IRA, at the end, at age 65, she has almost $500,000 in the IRA. Nice compounding over 30 years. What though if she wants to start taking some of the money out? Again, 35 years old, 50K in, she converts all of the 50,000 to a Roth IRA, pays tax at 28%. I'm assuming this is her bracket. Maybe it's 10, maybe it's something different. And then invests the money that she has left over after the taxes are paid into the Roth. So we got 50K. We're going to put all 50 into a Roth. I got to pay 14,000 in tax. I now invest the 36,000. And now you can see that, again, using this number, it's going to be a considerably lower amount. And the reason for that, obviously, is that I'm only investing 36,000 instead of 50,000. So in this case, you can see there's a real big difference between the two, right? Because this person was able to start with 50. This person could only start with 36. Now, obviously, the Roth is going to be tax-free distributions. So when this 358 comes out, there's no tax. When this almost 500 comes out, there is. So that's a real big difference. But I hope you can see the one really big difference here. And that is, what if Steph decides that she's going to convert the entire 50 and pay the taxes? Again, this could be 5,000 if she's in the 10% bracket or whatever, but pays the taxes outside of it. Now she can invest the entire 50,000 in the Roth. Obviously here again, these are the same numbers. And so we're not going to have a difference between the Roth and the traditional and what you end up with, except for when we take the money out. The traditional is going to pay tax on the $500,000. The Roth is not. And that's really where the real big difference comes in. So hopefully this wasn't too overwhelming, but these are the things that I see at the end of the year and what I'm going to be looking for next year, certainly in January or whatever. And I will, of course, be watching the next couple of weeks to see what, if anything, comes out of some of the Democrats' proposals as far as increasing taxes or changing some of the tax laws go. But I'll leave you with this particular quote here about fair in connection with income taxes. So don't expect fairness no matter what happens. And have managed to keep us right on schedule here at 7:31 Mountain Time tonight. So I am going to turn this back over to my good friend Don Pendleton. And I don't know if I wasn't paying attention to see if we have any questions or what have you, but Don,
we've got some great questions.
Good.
Yeah. So,
good deal.
Okay. So if you go to the top of the screen, because you're going to have to read this one with me, because there's too many numbers in here. So I don't know if if we can get too specific. Maybe it's a general question. With long-term capital gains, tax rate is 0. If you're in the 10 or 12% bracket, which for tax filers maxes out at 40,000. Does that not including the standard deduction?
Yes.
If so,
yes,
okay.
It does include that. Let's just stop with that question. So yes, it includes it.
Okay.
And if so, yep.
With the standard deduction being $12,550, can you take the long-term capital gain of 53,000 at zero?
Yeah.
Okay.
Yeah, I see what he's saying. So yeah, that's a good thought, right? You have no income. Now we put this income onto somebody who now can file a tax return and potentially pay no capital gains tax on that 40,000 and some dollars of taxable income. Pretty sweet.
Okay, good. Nancy is asking, in the gifting example, do you give stocks? I think that was the example that you gave, wasn't it? It was stocks.
Yeah, you would there because the example I had was you actually would gift the stock, because if you gift the cash, you sell the stock and gift the cash, which you certainly can do, you've got to pay the capital gains tax. And so what we're trying to do here, like the prior question, is we're trying to get the capital gains tax to be paid at somebody in a lower rate, right? Either 0% or 15% if you happen to be at a higher rate.
Okay, good. Helen, does it matter if it's a regular IRA or a Roth for the kids? It certainly matters.
Big
Maybe
time.
explain that.
Almost all financial planners that I've seen advise kids to put it into a Roth, whether it's a Roth 401k or whether it's a Roth IRA or what have you. And that's because they have, a 20-year-old has 45 or 50 years before he or she has to take the money out. And so you're getting all this compounding. And then when they take it out, there's nothing due on it. And so but it's a math problem. If you want the tax deduction up front, and there's certainly reasons why you may want that, you can certainly go a traditional or, a solo 401 or what have you. But big advantages one way or the other, whether you want the upfront deduction of a traditional or you want the back end of not paying taxes on the amounts you pull out. So big differences.
This Roth conversion for people, the option, and there's so much hype about now is the time to convert, and rightly so. But I look at it, I had some people ask me over the weekend, man was 70 years old. He says, do you think it's a good idea for me to convert to, from a traditional to a Roth? He's got about $100,000 in there. And I says, well, what kind of rate of return are you getting? He says, oh, I'm very conservative, probably 2 or 3% a year.
Mm-hmm.
And then the answer for me was, why? No, I wouldn't pay the taxes on it now. I would wait at least on that. But if you were getting 18, 20%, it really is a math question. We look at the age that you have and the rate of return that you're getting. If you're conservative, it may never break even. You pay the taxes now, but it may never break even with that. But if I'm getting a good rate of return and I've got a long time, these Roths, I'd rather pay taxes on the seed than the harvest. Scott, your thoughts on this?
Yeah, it's strictly, to me, a math problem. You can go into investment calculators, that just Google that, and you can punch in all these different hypotheticals as far as, well, what if I put 10,000 in, or what's the value? The question here is, do I want the tax deduction up front in a traditional IRA, and then I'll pay taxes whenever I pull it out? Or do I want to pay the taxes up front, and then down the road, I get all the money tax free? And I think the younger you are, the more the Roth makes sense. Of course, the more money you're making right now, maybe the tax deduction makes sense, from your business. You can also have one of each too. You could have a traditional IRA and you could have a Roth 401k too. So you could have a little bit of both if you really wanted to. But again, a financial planner, this is bread and butter for them.
But Helen, where kids can make up to $12,600 in earned income, and the first $6,000 of that goes into a Roth IRA, we're assuming the taxes have already been paid because they were in a zero tax bracket.
Right.
For kids, and because they've got such a long time, almost always the Roth is probably the better answer. Would you agree?
Yeah, I definitely.
Yeah. Okay. self-employment plan, is that
Mhm.
only for 1099 income business owners? Can you speak more on the SEP plan?
Okay, so SEP is self-employed pension plan. And it is for anybody basically. I mean, you can have that through any business. And so as long as you have business income, you don't have to have 1099 income, although that certainly works. So let's say in my law practice, when I had my law practice going here in Denver, if I made $100,000, then that would be income coming in. There would be no 1099 involved, but that would be business income. And from that, then I could pay wages. I could then use a SEP plan for that, or a 401k. But it applies to any business entity can use a SEP. Okay, you don't have to have a corporation. It can be an LLC. It can be a sole proprietorship.
Okay. Let's spend a minute and Scott, will you break down the difference on the tax side between a sole proprietorship or an entity taxed as a C or an S corporation? For a small business, what do you see are the major advantages of each?
Well, yeah, that's one for an entire webinar, right, Don?
Yes, it
But
sure is.
no doubt about that. When you're looking at the LLC, and I think this is sort of a choice of taxation question. When you set up an LLC, depending on how many members you have in that LLC, how many owners you have, is going to determine how it's taxed. So if you have one owner, it's going to be disregarded for tax purposes. Now, that doesn't mean that you don't have to pay tax. It means that you're going to be a sole proprietorship at that point. If it has two or more members, it's going to be a partnership. And if you don't like that designation, right, if you have one member and you don't want to be a sole proprietorship, or if you have two members and you don't want to be a partnership, then you can elect to be an S Corp or you can elect to be a C Corp for tax purposes. And that's a decision that every business owner has to make independently with any advisors that they have in trying to decide how much money you're going to make with the business. Is it going to have losses? Is it going to have gains, income? Who are the owners, and what happens if we tax it on their return, right? Are we taxing it on, a kid's return that's making $5,000 a year? Or are we taxing it on an NBA basketball player that's making 50 million a year? Big differences. So I think that's what you're looking at really is how are you going to have that LLC taxed? And you get to decide what the answer to that question is when you set it up.
And we have taught full webinars on,
Mhm.
what is the best tax structure for your business? Should you be an LLC or a corporation or sole proprietorship, and how to tax the little bugger? Yeah. Anyway, thank you for answering that. Helen asks, once I maxed out my Roth 401k, should I now, or could I contribute also to a IRA in addition?
Yes, you can. So you max out your Roth. Then the next thing I would do is max out my IRA, whatever that is. It could be Roth or traditional. And then after that, after you've maximized any pension sort of, retirement sort of accounts, then I think I would put the money into a taxable account and invest it at that point. But it's really, really nice to get the tax deferred gains on the investment income.
Yeah, and Scott has taught webinars for us in the past where we talk about real estate, and we talk about the advantages sometimes of having real estate in a taxable account so that you're eligible for depreciation. But we lose that in a tax-free environment, but it's also tax-free. And so sometimes we want a combination of both. But anyway, thank you for that. Bert, how about the growth of the asset though, and the time of the tax? I think we answered that, didn't we, Scott?
Mm-hmm. Yes. Yeah.
I think we did. Could you show Roth versus traditional comparison slide again? Will you go back to that slide? Do you mind?
Yeah. Yeah, absolutely. Okay. What's the next question?
Okay, traditional at 497, net of 28,000, is still the same. Is that the same in the Roth? Rob's, I guess, referring to a particular slide. And I'm not
Right.
sure which
Yeah, I'm not sure what
slide it
that.
was.
Yeah, I think that I had a couple different slides here, and it's interesting that that the reason that I had the two different amounts is because I made an assumption that you would pay the taxes out of the conversion amount, just to show you the differences there. And I'm looking at the next question, which is kind of interesting because Greg is talking about here. He says your Roth example is misleading and that you don't address the effect of paying the taxes on outside money. And obviously there, it's like, if Greg, if you were, if we were doing this class live, I'd say, hey, hang on, Greg, just give me 1 second here. Just give me 1 second, because I do have that particular slide in there. And I think that was what he was trying to show. And that was a really, really important point. And that this is the slide that, we were kind of looking at. I'll erase some of the red stuff here.
Yep.
But this one is like, why would you have these differences? The numbers should be the same. And exactly right. And that's why we have to go down to this one and show that, yeah, if you can pay these taxes outside of it, my goodness, you don't have to worry then about it. And at the end, you get the same amount of money as you would in a traditional. It's like it's a home run if, like Greg was suggesting on here, if you pay these taxes up front and not out of the conversion amount.
Okay, good. Nancy's asking, I anticipate receiving 2021 K1 limited partnership loss. Can I offset this loss with all incomes, meaning rental income, stock gains, any investments you can be writing off against other losses against investment gains? Is that fairly accurate?
No. If she's getting a K1 from a limited partnership, that's a loss. It's going to be a passive loss. So she can't offset that against all income. They'd have to be against passive income. So if you have passive income from another partnership or something, then you'd be fine to offset it. Otherwise, it becomes what's called a PAL. It becomes a passive activity loss, and you have to carry that forward until you either get rid. This gets very complicated, but either you get rid of the asset or until you have passive income.
Okay, good. Jen, what is the tax law on clients' gifts for 2021?
Client
gifts.
Yeah, same thing, $25 maximum. If you give it to a person, if you give it to a company or something, there is no maximum on that. Can't be entertainment though.
Okay, but if I gave a client a $300 gift, have I exceeded? And it was, does it fall under the category? It still needs to be reasonable for the amount, for.
Yeah, that's not something the IRS looks at. The rule, generally it's because it's just not, it's not a big issue typically, but the rule is that, you can give $25 per person per year in client gifts, and there's no taxable issues there. If you gave $100 to, ABC accounting firm, that's fine. But if you gave it to Joe Smith accountant, then you may have that $25 limitation. Again, it's not something that, the IRS really is going to be looking at, on a real, I don't know what the right word is, real microscopic sort of, we're going to be looking for these sort of gifts. I've seen a lot of people call it marketing expenses. If it's entertainment, it's not deductible. And if you call it gifts, you do have that limit.
Okay, great. Where are we at? If you're already enrolled in Medicare,
that one I don't
still
know.
Set up and contribute to a FSA.
Flexible savings. I don't know the answer to that one.
Okay, good. My son's 17. He makes 20 grand. His AGI 70 grand with 40K LTCG.
Long-term capital gain.
Okay. Does he pay zero taxes for long-term capital gain?
No, because he'd have to, here he's got a $40,000 long-term capital gain. Oh, I see what we're saying here. I'd have to figure that out. It's a little late in the day for me right now. I see what he's getting at, though. As far as this, his AGI is 70K. I assume he's single, and so then we'd have he'd have a, let's say, a $9,000 standard deduction. You have 61,000. So some of that would be taxed at a lower rate, but some would be taxed at a 15% rate. So he'd get a blended rate out of that. I'd have to punch it out on a calculator to figure it out.
Okay, good. Thank you. Okay. Can you please re-explain the gray blue in the conversion table? Okay, so back to that slide one more time.
Yeah, what all this conversion table means is that if your current tax rate, when you look at the number on the left, you look at the number at the top, you put those two together, whatever column you're in, if it's blue, the advantage is to a Roth, and if it's brown, the advantage is to a traditional. And so you can see that, look at the bottom here, and the more brown it is, the more traditional is favored. So this guy at the very bottom is in a 45% tax bracket. He's going to be in a 10% bracket when he retires. He's much better off to get the deduction today because he's going to be in a real low bracket when he retires. And then the flip side of that is this guy at the top that is in a 10% bracket today, but expects to be in a 45% bracket when he retires. He's very, very blue in the upper right, meaning that the Roth is highly advantageous.
Okay, good. Thank you. Please explain how charitable donations save tax. All donated money is gone. Does it make sense to donate more money to save some tax?
Well, that's a good point, because what we're talking about with a tax deduction is not the same as a tax credit. So if you've got if you deduct $100 of charity, you're going to save money at whatever your tax bracket is, up to a maximum of 37%. So the richest person in the United States, when they donate $100, would still be really donating $63 to charity and getting a $37 tax deduction in effect. So it's not a dollar for dollar credit.
But the example you used where you're gifting, somebody has $200,000 of income, we're kind of assuming at that level that they really don't need the income. They've got the income, they don't need it. They're trying to reduce their taxes. This is probably not the normal person in America who lives on their income. Is that accurate?
Oh, I think that's very fair. I mean, how many people, if you think about it, in the next 2 weeks are going to sit down and think like, should I write that $400,000 check to my church today, or should I do it next month? Right. I mean, it would be a great problem to have, but that's not for most of us.
Yeah, it's not typical. But what I really do like what you said about grouping your tax deductions. Maybe I don't have enough to itemize this year, so I'm going to hold off until January 1st, because next year with my, with property taxes and with my interest income, my mortgage interest and my charitable donations, now I've got enough to itemize where maybe, that made perfect sense what you said about that. Thank you. Who can you gift stocks to? What are the more detailed rules about that?
Well, you can gift stocks to anybody you want. You can make a gift of, stocks to whoever, your kids, or, you could do it to your next door neighbor that you don't even know. So you don't have to have any sort of relationship. In order to do that, somebody like I work through TD Ameritrade. So I would go to TD Ameritrade and say, instead of selling these 100 shares of Microsoft, I want you to transfer them to, this account. And then that account would be for my daughter, let's say, or whatever. And then my daughter, once she received the stock, would then turn around and sell it.
Okay, good. Thank you. Can the 2022 tax rates changed by law that are not signed by the president until February 2022?
Well, the question is, can they be made retroactive? And they could, yes. Whether they will or whether they should, that's a different question. But yeah, if Biden signs a tax bill in February that goes back to January 1. I mean, there could be court challenges on the retroactivity, but it's been done before.
Yeah. And which, if they are going to change it in February, it makes sense not to have a split year, to have the same tax rate for the entire year. So you would kind of expect that they probably would if they don't get around to passing the tax law, in December.
Mm-hmm.
All right. Anonymous, are there any strategies in Roth conversion timing during the year? January versus July versus December? Or is it all,
Nope.
pertinent to the tax year?
Yeah, it's all the same. It's all the same there. I mean, that's an investment decision of, when do you want to make the conversion? Because you remember you could, if you're making a $50,000 conversion in their securities, tomorrow maybe that 50,000 is 49,000 or 51,000, and so there's a timing issue on when you do it, because on the day you make the conversion is the date that you set the value for taxes. But generally, I mean, I would say do it as soon as possible so you get all the income in a Roth as opposed to a traditional. For me, that makes the most sense.
Okay, good. And for real estate, as it continues to appreciate or get ready to sell, it could have a significant difference. Yeah.
Yes.
Okay. I just brought a vehicle for business. The amount of taxes was 68,000. The amount with taxes was 68. How much can I deduct? It kind of depends a little bit on the weight of the vehicle, doesn't it, Scott?
Yeah, weight of the vehicle. A normal vehicle's around 18,000, I think. You can go up. Section 179 on an SUV is about 26,000. So there are a couple different ways you do that, but there's a really good IRS publication on that, and it's also in a lot of my materials as well.
Okay, good, thank you. With the gifting a kid, you can gift cash or Roth contribution. You can't really gift a Roth contribution, can you?
Well, you could in a sense of, let's say that my daughter worked and she made $7,000 in W-2 income. I could then gift her $6,000 and she could take that $6,000 and put it into an IRA for herself. And
Correct.
That would work fine. But in order to make a gift, like the cash gift, and then the kid puts it into a IRA, the child has to have some sort of earned income, W-2 income, something like that.
At least to the value of what she's contributing.
Right. Mm-hmm.
Right. Okay.
Yep, that's
I
right.
was not sure the difference between this and the kiddie tax. Can you explain the kiddie tax?
Yeah, well, the kiddie tax issues are for taxable accounts, not IRAs.
Okay. And that 12,600 number that I threw out was for earned income.
That's right.
If the child only has passive income, they can't earn, what is it, 2,200 that they can earn in passive income?
Yeah, the investment income, I think, 2,200. And then so the child could have no W-2 income, let's say make $5,000 of investment income, and 27, 28, 2,900 of that would be taxed at a higher rate than the child's rate.
And still can't contribute to a Roth because they don't have earned income.
Correct. Yeah.
Okay. Convert IRA to a Roth IRA and pay taxes using taxable income. W-2, is it able to deduct or reduce taxable income?
Well, no, anytime you make, and the conversion is going to increase, not reduce taxable income. So no deduction.
Okay. How can one gift stock options awarded by an employee?
Yeah, employer, right? That's a tough question because it would depend on the employer. Who owns the stock options? Are they vested? Are they incentive stock options? ISOs are what they're called. I mean, there's a whole lot of different ones. So, but if you actually own the stock options in your account, then it's treated like any other asset. In theory, you could gift it.
Okay, good. Thank you. Is Kiddie Tax only for dependent? And my son files his own tax with earned income. So is he not subject to Kiddie Tax?
Yeah, I mean, again, it's going to be depending on the age of the son and how much money the son makes in investment income. So that one, again, I think we've answered that one.
Okay, good. You know what? We're running a little short on time. We promised everybody we'd do our best to answer questions, but we're coming down to the end of the wire. Scott, you are going to be at our next 3-day asset protection class. And students, this was recorded, and so you can go back and listen to that as many times as you can. But let's see if we can take just a few more questions. If an S corporation has limited income, is it worth setting up a 401 solo plan?
Probably not, because again, to set up any of these retirement plans, you have to have earned income, W-2 wages. And if the S corp doesn't have much income, I wouldn't typically advise the S corp to be paying wages out.
Okay, they could do a SEP plan. They could still contribute to an IRA, but I get so many people so excited about the 401 solo plan because they could, contribute $58,000, but it's also limited to 25% of your salary. And so it means you got to be making a pretty whopping salary to be able to contribute $58,000.
Yeah, to a SEP plan, absolutely. And that's kind of the thing I think to look at is what's the best plan for you? Because in the example we just had with the S corp, let's say the S corp made, $100,000 and had 80,000 of expenses, so it has 20,000 left over. We pay a $20,000 salary. You could only contribute $5,000 to a SEP. We may want to make a $8,000 salary and contribute 8,000 to a simple plan. So again, there's lots of different things, and you wouldn't normally look at as simple as that's going to be the way we want to go, because you can contribute a whole lot more to a SEP or a 401k. But in some instances, it's a great way to go. So again, the circumstances are going to dictate what you do. And I think that's one of the things that like at the 3-day events that you were just talking about, Don, that, we have the time, we can go through a lot of these different scenarios of, here's how you do this, here's how you do that, that these questions that we're getting tonight, these are incredible questions. Cause I mean, these are exactly what people should be thinking of, right? I mean, how do I do this? How do I get my kids involved? Notice where everybody's going with this. Everybody is trying to think of ways that they can have their money go further, right? So if I can do my investments here and I do a 10% return, I'd much rather get that in my retirement account and pay no tax on it than get a 10% return and have to give a third of it to the government, right? That's really what we're looking at here. And so these, I'm sorry, we could probably be here for another 2 or 3 hours answering the questions and going through this stuff, but they're spot on that I think people are getting the right idea here, as far as what we're trying to do and how we're trying to structure our thoughts as to what's the best way that, that we can do tax planning for ourselves. And that's really what this is all about, and what the 3 days are about as well.
Well, and I appreciate that. I'm always impressed by our students' questions, and that's exactly right. How do I involve my kids? What's the max I can contribute? Is this tax deductible? You're thinking outside of the box, and we absolutely can, So a lot of the questions too, like what's the limit for the SEP contribution? Okay, we've already covered that. It was $58,000 up to 25% of your salary. So go back and listen to this, because a lot of the questions as I'm scrolling down we've answered them. When's the next webinar about sole versus S and C corporations? You know what? We'll put that on the calendar and try if we we'll hit that pretty soon. Okay, how's that? Can you touch on HSA, health savings accounts for tax planning? I think the limit right now this year is $8,100 for a married couple over 50. Next year it'll go to 80. 300. You can self-direct those. It's a, as I understand it, Scott, you get a tax deduction when you contribute. It's tax-free growth, and it's also tax-free as long as you use it for medical expenses. It's a triple tax-free, but I love HSA plans.
Yeah. Yeah.
Okay, Scott, I don't want to take any more of your time, but is there anything here? And a lot of you're thanking us. We appreciate that. Scott, any other questions here that jump out at you?
No, it's just kind of flipping through a few of these here as well. I mean, one that I see here from Gary says, does a big state tax bill this year end up becoming a part of next year's SALT tax deduction? And the answer is yes, it does. And that's something that if you've got to decide whether to pay taxes at the state level this year or next year, I'm looking at paying them in January rather than December, because I think they're going to repeal the SALT tax deduction, which is the $10,000 limitation. But again, I don't know that. If if this was 2 weeks ago and we're in Las Vegas, I'd put $5 on that bet at the table, right? That next year the SALT deduction will be limited, but I don't know.
Yeah. Scott, thank you so much. I'm sorry that we did not get to all the questions that were on. We never do, Scott, when you're on. There's always more questions. And you're right, we go on for hours. If you have not signed up for a 3-day summit, we're going to try to answer a lot more questions at that time. And Scott's right. We do have a lot more time with that. I know Scott's time is limited, so I need to thank him for your time, Scott, and thank all the students that stuck with us for an hour and a half talking taxes on the East Coast. You were here very, very late. We appreciate you being here. Scott, any last final words?
No, I just want to thank everybody for taking time tonight, or if you're listening to the recording, for listening and thinking about taxes. And I just wish everybody, the next couple of weeks here as we get through the rest of this year, to have a really great holiday season, spend some time with your family, and just enjoy life. But thank you, Don, and thank you everybody for attending this presentation.
Thank you for being on. Thank you for your interest in your life, in preparing your taxes, and doing what we can do to save money on our taxes, to create a little peace of mind for our family, and do the very best we can to be good financial stewards of our wealth. Thank you, all of the students that are here. Thank you, Scott. Appreciate that. And Merry Christmas. Happy holidays to all of you. Have a great evening, and we'll see you at the beginning of the year for a brand new webinar series. Thank you. Good night.